Hello and welcome to the latest in our Insider Interview video series. Today I'm joined by Job Curtis, who is the fund manager of the City of London Investment Trust. Job, thanks for coming in today.
It's a pleasure.
So Job, could you start off by summarising how the trust invests in order to provide growth in both the capital and the income?
Well, City of London has at its core a portfolio of consistent companies, but how I invest is I'm trying to select companies that can grow their profits and dividends over the long term, but also not overpaying for them. And valuation plays an important role in my stock selection, because even if you're investing in a good company, in my opinion, if you overpay and pay too high a price, then you can lose money share price wise. Similarly, shares might appear very cheap, but they could be cheap for a good reason. So I'm trying to avoid those so-called value traps, which struggle to grow at all and end up cutting the dividends. So I need to be in companies with good cash flow, who are able to invest enough for the long term to grow the profits and dividends over the long term. The other facet of the investing is that I'm quite a conservative personality. So I think with any fund manager, the portfolio will reflect the personality of the fund manager to a degree. And so City has a conservative portfolio. I like companies with good cash generation, and particularly in cyclical sectors, I like strong balance sheets. I don't like a combination of a company with high gearing or leverage or debts in a cyclical sector. That can be very dangerous in an economic downturn. So overall, City's portfolio is quite conservative. I mean, if it's a race between a tortoise and a hare, we're kind of more of a tortoise than a hare.
And what's the split in terms of company size? Is the majority of the trust invested in larger companies that are in the FTSE 100?
Yes, City is predominantly in large companies. We state that we are going to be predominantly in large capitalisation equities. So, we have a heavy bias towards FTSE 100 stocks, and indeed we also have some 15% of the portfolio in some large overseas listed companies, which are all large companies. So we do have some medium size and a few smaller companies, but we're predominantly in the large cap end of the market.
And being in that part of the market has particularly paid off year to date in 2022. Could you explain why, and could you name a couple of stocks that have performed well this year?
Yes, I think the large companies have performed much better this year than medium and small companies. I mean, it's partly because if you look in the large part of the market, one sector that's big in the FTSE 100 and large companies is the oil sector, and of course the oil price has gone up a lot, and that's benefited BP and Shell for sure. Also, certain defensive sectors like pharmaceuticals are mainly found in the large companies, Glaxo and AstraZeneca. I mean, within City of London's portfolio, we hold BP, Shell, Glaxo and AstraZeneca, but particularly important for City of London has been BAE Systems, which is our leading defence contractor, where the shares have been very undervalued in my opinion, but because of the Ukraine war, they've had something of a re-rating this year. And in addition, one area that's been very unpopular for understandable reasons has been tobacco shares, and they've actually also had a very good year, given the consistency of their profits and cash generation. And British American Tobacco is a big holding for City, which has done well this year.
And given there's been a lot of volatility for the UK market in general this year, have you been looking to take advantage of any opportunities of sectors or shares that have potentially now look mispriced? And I was also wondering whether any of the mid or small cap names have caught your eye as well?
Yes, I am trawling around in that sort of mid and small cap area, because obviously valuations come back a lot and it's more interesting. I mean, I'm still quite wary of what you might call consumer discretionary stocks, areas like travel and leisure and retail. I think the consumer, is under a lot of pressure at the moment with the cost of living crisis. So I'm sort of still kind of fairly underweight in that part of the market. But I have spotted some opportunities. Within the mid-cap area, we've bought Hays, which is a recruitment consultants business, is split a third UK, a third Germany, and a third Australia, New Zealand. And it's doing very well at the moment with fairly full employment and wage growth it's benefiting from. I've bought Wincanton, which is a logistics company, which is very cheap and doing well, benefiting growth in e-fulfillment. And I've also bought Rathbones, the wealth manager, which is in a kind of secular growth sector, in my opinion, and is one of the leaders in that sector. So I am seeing opportunities, but I'm not lowering my criteria at all for investing in mid and small cap.
And in order to fund those purchases, have you been selling any of your existing holdings, or has gearing been increased?
Well, we've actually, in that wealth management sector, we had a holding in Brewin Dolphin, which was being taken over by Royal Bank of Canada at a very high price relative to where it was previously trading, and so really I've reduced that in order to fund Rathbones' purchase and keeping money in that sector. And I think that's one of the attractions of that wealth management sector is some of the consolidation. I mean, also in terms of other sales, we do make reductions and take profits, in situations, across the portfolio. In the house building sector, we've had a successful holding in Berkeley Group, and I did sell out of that in June, but we still retain holdings in Persimmon and Taylor Wimpey. I just felt that against context of rising interest rate environment, it was best to reduce some exposure to house builders. In terms of the gearing of the trust, no, we've kept the gearing at quite low levels. It's around 7% at the end of June, which is on the lower end. We have got some very cheap debt, which we've taken out in recent years. So we're borrowing out to 2046 at 2.67% and out to 2049 at 2.94%. These are fixed rate borrowings, and they were struck over the last 2 or 3 years when interest rates were extremely low, and they now look really quite well judged, and I think they're going to benefit Citi's shareholders for many years to come.
You've mentioned interest rates being on the rise. Have you been increasing exposure to banks? I can see in the top 10 there's HSBC. Do you own any of the other 4 major players? And I was wondering why it is HSBC that's in the top 10 and not any of the others.
As we also own Barclays and Lloyds, so we've got 3 banks. HSBC is our biggest holding. It's also the biggest bank by market capitalisation. I mean, we're actually underweight relative to the index, but it is a big position. I mean, most of their profits they're made out in Asia Pacific, and their great strength is this huge deposit base they've got, and they will be a big beneficiary of rising US interest rates because the Hong Kong dollar is linked to the US dollar. So the banks in general do benefit from rising interest rates up to a point. Of course, if it tips the economy into recession, then it's not good news for the banks. They start getting losses from their loans. So you have to be a bit careful, but I think the sector's reasonably good value. It's just been a very difficult sector over the years. I think it's a big political football ever since the financial crisis, when the taxpayer had to bail out the banks. I mean, people in Whitehall and Westminster have kind of looked and equivalent centres, overseas have, been quite careful with the banks, and there are a lot of rules and regulations. When the pandemic hit, the banks were ordered to stop paying dividends immediately. So I think it's a tricky sector in terms of both the kind of political and regulatory interference, and also the fact that will suffer if the economy goes into recession. So we do have some exposure to banks, but we're not overweight. I mean, the sector which also will benefit to a degree from rising interest rates is insurance, and we have got quite big positions in both life insurance and non-life insurance, and that's an area where we're overweight in. So we kind of prefer to play that area of the market on the rising interest rate theme rather than the banks. So in life insurance, we've got big holdings. Our biggest 2 holdings are Phoenix and Legal & General, which are on very attractive yields and got slightly different business models. Phoenix has been a consolidator, but it's now growing its business, and Legal & General has got a very strong position in annuities. And then I've also got a big holding in M&G, which is a mixture of fund manager and life insurer. And then in non-life insurance, we've got a mix. We've got some interesting. We've got Direct Line in motor and property and casualty. They're suffering a bit from inflation, actually, of the claims, so the cost of kind of making repairs and second-hand cars, that type of thing. But I've got some interesting smaller vehicles such as Beazley, which is a kind of Lloyd's-based specialty insurer, which is doing very well out of cyber insurance at the moment. I've also got a big holding in Munich Re, the big reinsurer global reinsurer based in Germany. So we got a combination of some very interesting stocks in those both areas offering decent yields and I think prospects for capital appreciation.
And as you mentioned earlier, you have some exposure to non-UK stocks. Could you explain why, and could you give a couple of other examples?
Yes, it's partly to provide some diversification in some sectors. I mean, for example, in pharmaceuticals, you've just got Glaxo and AstraZeneca UK listed. In fact, Astra's done very well, but We've also, in City of London, we hold Merck of the US, which also done well over the years. We have Johnson & Johnson, another American company, Novartis, and also Sanofi, the French-based international pharmaceutical company, which is a kind of more recent purchase. And similarly in oils, rather than just having BP and Shell, we have some Woodside, which is an Australian listed oil company, and we also have Total Energies, which is the French listed. So I think it gives a bit of extra diversification rather than just having everything riding on kind of a couple of UK listed stocks. The other thing is there are some stocks which you just can't find equivalent in the UK. And just under 10 years ago, I invested in Microsoft City of London, which has been a highly successful investment. And at the time, it was on a 3% dividend yield and very out of favour. And it's really gone up many times since then. I've taken some profits, but but obviously there's no equivalent to Microsoft in the UK market. So I think that's another example of where one can benefit from the overseas. And the other side is that recently some companies have delisted from the UK to overseas markets. And a good example, beginning this year, BHP, the miner, basically made its complete listing in Australia, rather it was 50-50 Australia, UK before. And just because it does that doesn't mean to say you have to sell it if it's a good company. It's been a great dividend payer, BHP, in recent years. So we've hung on to our BHP, and there's another example, Ferguson this year, which was UK listed, moving its listing to America, where its main business, where almost its whole business is.
Job, thank you for joining us today.
It's a pleasure.
That's all we have time for today. You can check out the rest of our Insider interview video series on our YouTube channel, where you can like and subscribe. Hopefully see you next time.